So, are all options a race against time? Welcome back, options traders. And this is a question I get from a lot of new traders. And it usually shows up in the form of a reason for not using options. And a lot of traders will say, well, the reason I don't want to use them or explore them is I've heard that they're a race against time and that they're always decaying away. And so it just becomes that much harder to make money. Well, is that really true? Well, like all option strategies, it depends on how we structure the strategy. So, are all options a race against time? I'll give you the answer up front. No, they're not. But let's go find out why. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, remember, whenever we're talking about shares of stock, I often say that they are one dimensional. And that just simply means it's an up down type of a bet. That's really all there is to it. If you think that Microsoft is going up, you would buy the shares. If you think they're going down, you could short the shares. But it's a directional play only. And that's because stock is only delta. There's no extrinsic value. However, when you start delving into options, that's no longer true. Now, it is true that you can create, in fact, probably most strategies use some form of direction. So, yes, you can create strategies that require the stock to go up or down. But in most cases, you also have to figure out if you think it's going to be a slow or fast move. Now, this usually shows up in the form of gamma. And this is one of the big distinctions between options and shares. So, an analogy that I often make is think about it like between a helicopter and a car, comparing these two. So, a car, we know, goes forward and backwards, one dimension. But a helicopter can also go forward and backwards, but it can also go up and down. It can also go side to side. It can also bank left to right or roll front to back, and it can also spin. There's a lot of different degrees of motion on a helicopter that are not able to be done in a car. So that's why just because you might be a great driver doesn't mean you should jump into a helicopter and expect good results. But that's exactly what happens to a lot of options traders. They come from a stock trading background, one dimensional background, and they say, oh, I'm very good about picking direction and I'm just going to use options because they're a cheaper form of stock. And they don't realize they have all of these other moving parts that are going to complicate that. So, yes, it is true that, again, for most cases, options need direction too. Most of our strategies are going to be either bullish or bearish. We could also look at the lack of movement. We could do a neutral strategy, but this is all a delta type of a decision. Do you want positive delta, negative delta, or zero delta? That would be delta neutral. So those are directional types of choices that you have to make. But with the options, we also have magnitude to deal with. And that's because, again, options have an extrinsic value. And that means that the expiration break-even point is higher than it is for shares of stock. So, for example, if you buy shares of stock for 100, your break-even is 100. So not counting bid-ask spreads, but the first penny of movement in your direction to the upside is going to produce, theoretically, a profit. It's just pure delta. But compare that to, let's say, if you buy the $100 call for 5. Now your expiration break even is 105. See, that's not true for the stock. For the stock, you'd be up 5 points with the stock at 105. And for the option, you would just break even. And so this is why we often say that there is this idea of magnitude. It's the size or the distance that the stock has to move to allow you to generate a profit. Sometimes I make the analogy of it's like a point spread on a football bet. If you bet on a team with a 7-point spread against it, you can't say that you're leading because you're up by 3. You haven't beaten the point spread yet. And that's exactly what's happening with the options. And again, that's showing up in the form of extrinsic value. So that's the magnitude side of it. Where does the speed side come in? Well, that's because options have an expiration date. So traders must get the direction, up or down, and the magnitude, how far up or down. Got to get that correct, but they have to do that before expiration. So for example, let's say that this is time going on the horizontal and just dollars on the vertical. If the shares of stock are trading for 100, any stock price above 100 is a profit to you. If you're buying the shares, any price below 100 is a loss. Very easy to figure out. But if you buy that $100 call for 5, that's no longer true. You need the stock to be above 105 to show a profit. So see, for the stock trader, this entire area of green is a profit, but for the call buyer, this is an additional area of loss because the stock, this is at expiration, the stock closed between 100 and 105, or could even be below 100. But this would be an area of profit for the stock trader, but it's a potential area of loss for the option trader. So again, we have this idea of magnitude. Now, speed comes in because there's an expiration date. So let's say that this is the expiration date out here. We have to be right before expiration. So now we only have this area where we can be profitable with the option, whereas the stock trader can be profitable in this area. Now, this little red segment down here may or may not be profitable for the option trader, because if we get a big enough move prior to expiration, yes, you could still show a profit. It would be a loss at expiration, but you could be profitable before expiration if the stock gets up and moving quickly. So again, it's this idea of magnitude and speed. So these are the three things that you always have to account for when you are setting up your option strategies. So if your outlook is based on direction, strategy should focus on delta. If it's based on magnitude, focus on gamma. And if it's based on a quick move, you may be profitable even if the option never goes in the money. But in order to do that, you need speed. Might not even need a lot of magnitude, but it's got to get moving quickly. So again, you can see there's a lot of different moving parts in the option that are just simply not there for the shares. So now let's take a look at the money options. And I want to start here because this is where a lot of new traders start. There are benefits for at the monies. There are always trade-offs. But they like the at the monies because they say, well, I know enough to not buy an out of the money because I'm going to need this severe magnitude difference here to make money or speed. But I also don't want to pay for any intrinsic value because now that's potentially more of a loss. So at the money seemed to be a pretty good starting point for a lot of new traders. So again, let's say that the stock is 100 and the 30-day $100 call is trading for 5. Now it's an at the money option. The stock and the strike are the same. So this is all extrinsic value. And we've talked about this before in a previous video. It conveys the most information. So it's going to have the most amount of extrinsic value compared to any other strike for that expiration. And yes, that means that this $100 call will lose all of its extrinsic value by expiration. So for example, here's our risk graph. Here's our 100 call for 5. The black line is the expiration graph. We can see it lines up right there at 5. So on the expiration bell, we're on this black line. Remember, this is showing profits or losses. This zero line is break even. No profits or losses. We can see we break even right there at 105. Any area above is a profit. Any area below is a loss. So the blue curve is the current curve. And it's going to show what our profits or losses are right now. So over time, let's say this is 30 days to expiration in blue. Maybe a week later, it's going to shift down to the purple. More time goes by, it's going to shift lower. More time goes by, it shifts even lower. And finally, right on the expiration bell, it lands on the black line. It's going to look like this. So again, notice where your break even is, where this black line is crossing zero. It's right there at 105. Now, remember we have the 100 call. So you can see that if the stock moves anywhere between 100 and 105 at expiration, it's some type of a loss. Not a maximum loss, but it's some type of a loss. So in order to get a profit, we need it to rise above that. We've got to get above 105. So this is another way to see that we have a magnitude. We've got to get this first 5 points of movement, doesn't even count for us at expiration. And it's got to get there by expiration. So there's the speed. So again, traders look at this and they say, well, that's true for all options, and they are a race against time. And that is not necessarily true. This is where you have to understand your option strategies. So, one that I talk about a lot is a strategy called a stock replacement strategy, where it focuses on a very deep in the money option and it's going to mimic shares of stock. So, let's say that the stock is 100 and a 30-day $90 call is trading for $10.07. Well, notice that there's $10 of intrinsic value. That's because here you have the right to pay 90 for stock that's currently 100. So sometimes you can think of that as the meltdown value. I could exercise that 90 call, sell the stock, and pull 10 bucks out of it. So that $10 has nothing to do with the option or the insurance value. It's this additional 7 cents. So there's only 7 cents of extrinsic value. So in the business, we would say that this $90 call is trading at parity. Technically, parity would be exactly $10. When it's trading at parity, it's behaving exactly like shares. And that would mean that the strike plus the options price, if it were trading for exactly 10, 90 plus 10 would give you the current stock price. Well, right now it's 90 plus 10.07. It's trading for 7 cents above the stock price. But you know what? Close enough. We would still call that parity. And now only 7 cents will decay over time. See, this is the big misperception. Traders are afraid to buy this because they say, oh, I could lose 10.07 from time decay. No, you cannot. You can lose the 10 bucks only if the stock moves against you. So you do have a greater delta risk, but you don't really have this magnitude and speed that you typically have for most options. So let's take a look at the 90 call. Here's our bend at 90. We've got a cost at 10.07, but it looks like it's lining right up at 10. And up here, the break even is 100.07. So again, that's the 90 strike plus the 10.07 cost. So the break even is right there at 100.07. So now if you buy this call, you will profit for any stock price to the right of this break even. Well, that's 7 cents higher from where we are now. That's not really a need for speed or a magnitude. 7 cents isn't all that big of a move. That could happen in the next few minutes. So there's a perfect example, one of many, where we don't need magnitude and speed even though we're doing a directional play. And that's because we've used our option strategies and our Greeks to line up to meet our goals. So the main thing to remember is that this is why it's so important to have goals. If you understand your options, you can alter strategies to align with your goals. And if your goal is about direction, use deep in the money options, and you won't have to worry about the need for speed. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsa2z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.